What is value investing? Value investing is an investment strategy focused on buying securities that appear underpriced based on fundamental analysis. This approach was pioneered by Benjamin Graham and later popularized by his student, Warren Buffett. Value investors look for companies trading below their intrinsic value. The market price is what you pay for a stock, while the intrinsic value represents what the company is actually worth. The difference between these values creates a margin of safety. The bigger the gap, the better the potential investment. Value investing has several key characteristics that define its approach. Value investors focus on current company fundamentals rather than just future growth potential. They seek a margin of safety, a significant gap between the market price and their estimated intrinsic value. This approach requires patience, as undervalued stocks may take time to be recognized by the market. Value investors rely on thorough fundamental analysis of financial statements and business models. Their approach is often contrarian, buying when others are fearful and selling when others are greedy. Unlike growth investing, which focuses primarily on future potential, value investing emphasizes current fundamentals and seeks a margin of safety. The first key principle of value investing is the concept of intrinsic value. This principle states that every company has a true worth independent of its market price. The market price may fluctuate widely, but the intrinsic value changes more gradually based on business fundamentals. The second principle is the margin of safety. Value investors aim to buy stocks significantly below their intrinsic value. This gap provides protection against errors in analysis or market downturns, reducing risk while maintaining upside potential. The third principle of value investing is maintaining a long-term perspective. Value investors focus on sustainable business performance rather than short-term market movements. Over longer time horizons, stock prices tend to converge with intrinsic value, rewarding patient investors. The fourth principle is contrarian thinking. Value investors must be willing to go against market sentiment when their analysis supports it. Often, the best investment opportunities arise when pessimism is widespread, allowing for purchases at significant discounts. The fifth and final core principle is fundamental analysis. Value investing requires rigorous examination of financial statements and business models. Investors analyze metrics like price-to-earnings ratios, book value, debt levels, cash flow, and return on equity to determine a company's true worth. The margin of safety is perhaps the most crucial concept in value investing. Introduced by Benjamin Graham, it refers to the difference between a company's intrinsic value and its market price. Visually, we can think of margin of safety as the gap between what a company is truly worth, its intrinsic value, and what the market is currently willing to pay for it. Value investors typically seek a substantial margin before investing. Conservative investors might look for a 50% discount, while others might accept a 30 to 40% margin. This buffer protects against analytical errors, unforeseen problems, market downturns, and acknowledges that valuation is inherently imprecise. Warren Buffett famously summarized this principle with his 2 rules of investing. Value and growth investing represent 2 distinct approaches to selecting stocks in the market. Value investors seek companies trading below their intrinsic value, focusing on established businesses with strong fundamentals at a discount. Growth investors, on the other hand, focus on companies with above-average growth potential, willing to pay premium prices for anticipated future earnings. Let's compare the key metrics that differentiate these approaches. Value stocks typically have lower price-to-earnings ratios, often around 15, compared to growth stocks, which might have PE ratios of 35 or higher. Dividend yields are generally higher for value stocks, sometimes 3.5% or more, while growth companies often reinvest profits, resulting in lower dividend yields. Price-to-book ratios also reflect this difference, with value stocks trading closer to their book value, while growth stocks command a significant premium. These investment styles tend to concentrate in different sectors of the economy. Value stocks are often found in traditional industries like banking, utilities, consumer staples, and manufacturing. Growth stocks typically dominate emerging sectors such as technology, biotechnology, renewable energy, and e-commerce. The performance patterns of these strategies differ significantly over time. Value investments tend to show steadier, more consistent growth with less volatility over long periods. Growth investments may experience more dramatic upswings during favorable conditions, but can also face sharper corrections. Many successful investors incorporate elements of both approaches in their portfolios to maximize benefits. A combined approach offers diversification across investment styles, balances income with growth potential, and can perform well across different market cycles. Several legendary investors have made their fortunes through value investing principles. Benjamin Graham, considered the father of value investing, developed systematic approaches detailed in his influential books Security Analysis and The Intelligent Investor. Graham's approach focused on finding stocks trading below their intrinsic value, with a strong emphasis on the margin of safety concept to minimize downside risk. Warren Buffett, Graham's most famous student, adapted these principles while adding his own focus on business quality and competitive advantages. Unlike Graham, who sought many mediocre opportunities, Buffett concentrates on fewer high-quality businesses with long-term competitive advantages or economic moats. Charlie Munger, Buffett's partner, expanded value investing by incorporating psychological factors and emphasizing a multidisciplinary approach. Munger popularized the concept of mental models, drawing insights from multiple disciplines to make better investment decisions. Seth Klarman is known for his extreme risk aversion and willingness to hold cash when opportunities are scarce. His rare book, Margin of Safety, sells for thousands of dollars on the secondary market due to its valuable insights on risk management. Howard Marks focuses on market cycles and contrarian thinking, often buying assets when they are out of favor. Through his famous memos, Marks emphasizes second-level thinking, going beyond obvious analysis to gain investment advantage. While these investors share value principles, their specific approaches vary significantly. Comparing Graham's investment approach, comparing Buffett's investment approach, comparing Munger's investment approach, comparing Klarman's investment approach, comparing Marks' investment approach. Their long-term performance demonstrates the power of their value investing principles, despite using different approaches. Despite their unique approaches, all these legendary investors maintain these core value investing principles. By studying these masters, investors can develop their own approach while staying true to these fundamental value concepts. Value investing performance varies across different market cycles. Market cycles generally move through four main phases: recovery, expansion, peak, and contraction. During market corrections, value stocks with strong fundamentals often decline less than the broader market. In economic recoveries, undervalued companies frequently outperform as their true worth is recognized. However, during strong bull markets driven by momentum or in low interest rate environments, growth stocks may outshine value investments. The 2020 to 2021 period saw a significant rotation from growth to value as inflation concerns rose. Successful value investors adapt their approach to current conditions while maintaining core principles. Start your value investing journey by studying the works of Benjamin Graham and Warren Buffett. These foundational texts provide the core principles of value investing. Develop skills in reading and analyzing financial statements. Understanding income statements, balance sheets, and cash flow statements is essential for identifying undervalued companies. Practice calculating intrinsic value using methods like discounted cash flow analysis. This helps determine if a stock is trading below its true worth. Consider beginning with value-oriented index funds or ETFs before selecting individual stocks. This provides diversification while you develop your analysis skills. Cultivate patience and emotional discipline, key traits for value investors. Markets fluctuate, but value investing is about finding quality companies and holding them through market cycles. Remember that value investing is not about quick returns, but building wealth steadily over time through disciplined application of sound principles.